How to choose a mutual fund. That's the topic that we're going to talk about. And friends, this topic has come from one among you. Thank you for all your encouraging comments and remarks. We've been receiving a lot of commendable comments and requests. And this was one of the requests, and this goes out to you all. There are in excess of 4,500 different mutual fund schemes that are available in India currently, represented by 40 plus mutual fund companies, right? It's a plethora of schemes and choices that confuses any layman. Now the question is, how do you choose a mutual fund? This is what we're going to look at today. First up, choosing a mutual fund has two components to it. One, we as investors, and other, the mutual fund offerings that are available out there. But first, let's look at internal to us. We as mutual fund investors need to answer three questions before we decide to go look for a mutual fund. First, what is the goal that we are hoping to reach by investing in this fund? Very, very important. And the first question that we need to answer ourselves. If you're chasing a goal that is near term, like you're going to fund something in the next 1 year, then the type of scheme is entirely different from what you're going to do if your choice of investment is a long-term investment. So clearly, you need to look at what your goalposts are. That will be the first thing that will be determining the kind of mutual fund that you should pick up. Second, one needs to look at one's own risk appetite. What is my propensity to take risks? And broadly, investors can be bucketed into three categories. What is called an aggressive investor, a balanced investor, and a conservative investor. These are the three categories. Aggressive investor, very, very simply put, rule of thumb, is somebody who is willing to take risks to get a higher return, maybe even 20% return, but is also willing to forgo 20% on his principal at any point in time. So he's okay to see a loss in his portfolio of about 20%, 25% in his journey to make profit. So that's the profile of the aggressive investor. On the contrary, the conservative investor is somebody who does not want to see even 1 rupee from his portfolio go down. So he's a very careful, very considered investor. For him, the returns may be more moderate. He's not looking at a 20% return. He's just looking at returns that are slightly better than what the bank offers. That's good enough for him. Now, such an investor will be termed as a conservative investor, and the type of investments that he will be doing will be very different from the aggressive investor. The balanced investor is somebody who comes between these two, willing to take a little risk, but is also conservative to a certain extent. So it's a combination of these two. So extremely important, even before you consider investing, what is your nature? What is your temperament? And then look for schemes that fulfill your temperament. And the third important internal factor that we need to look at is, what is the tenure of my investment? Am I planning my retirement 20 years down the line? Am I planning my kids' education 5 years down the line? Or am I doing this as an emergency fund that I can withdraw at any point in time? Depending on what the tenure of the investment is, the nature of scheme that you can pick up will be very different. So first up, internally, if you're able to assess your goal, your risk appetite, and the tenure for which you want to stay invested, if these are captured, then you can look at the external, which is what are the different types of schemes available. There are a variety of different schemes available. For the purpose of today's video, I am going to look at only equity schemes as a choice. And within that, I'm created a framework which I call SPFRI. SPFRI framework will broadly give you 5 criterions by which you can look at mutual fund schemes and evaluate which ones work the best for you. Now, although the SPFRI starts with S, I'm going to start explaining about the P. Whenever you've seen a mutual fund ad in the television, you always find the disclaimer at the end that says past performance is not indicative of future. Yes, absolutely. The past is unlikely to repeat in the future. But really, when you start investing in a scheme, the first thing you'll have to look at is the past performance of the peer group. Now, any website or fintech will give you peer group. And what do I mean by peer group? If you're analyzing large cap funds, you want to know a bunch of 5 different large cap funds that you can choose to start analyzing. Now, this can be available. For the purpose of today's discussion, we have chosen to go with one such website, which is called advisorkhoj.com. Advisorkhoj.com gives a bunch of data points, and that's what we've used in today's video to explain this framework. Coming back to the performance, any mutual fund scheme will give you a bunch of performance highlights. Basically, how the scheme has performed vis-a-vis the benchmark. Every scheme must have a defined benchmark. As per SEBI and as prescribed by the Association of Mutual Funds of India, there are in excess of 67 categories of mutual funds, and each of those 67 categories will have a benchmark. So for example, a large cap fund will have a benchmark which is Nifty 50 or Sensex as a benchmark. So you can look at the past performance of the scheme based on how the scheme has performed vis-a-vis the Nifty 50. And you can do this over different periods of time. You can look at it over a 1 year, 3 year, 5 year and 10 year periods, which will give you a sense of how consistently the fund manager has performed and how well he has done or how badly he has done, depending on the timeline. There is also one more criteria that can be adopted, is that some of the fund houses also compare their performance with the peer group. What do I mean by that? If there are 25 large cap funds, then your performance of that one scheme can also be compared with the weighted average of the performance of all the other 25 in the category of large cap funds. So while one is a benchmark performance, the other is also a category performance, just to know whether you're performing above average or below average. So past performance is the first place to start with. So let's say you're examining large cap funds. It's a great idea to look at which are the large cap funds you're looking at and how they compare with the benchmark index as well as the category of funds that they are. So that's about past performance. Once you've gone beyond past performance, you have the F. F stands for fees. Mutual fund companies are in it for the money, my friends. They earn a revenue, a fee by advising you. So what is that fee? That fee is defined as total expense ratio, TER, and that's defined by SEBI as a percentage of the assets that they manage. That definition of how much they can charge, I will run through in a separate chart at the end of this. But the TERs will definitely be a point that you need to look at before you go ahead with your investment option. Now, TERs for direct funds will be much lower than regular funds, primarily because they offer a direct means of investing towards that end. But friends, it's not necessary that low fees means great performance. You need to evaluate. Some of the best performing funds, which are fund manager managed funds, also charge reasonably good fees. The idea is, as long as the fund manager is delivering great value, fee is definitely something that one needs to be willing to pay for higher performance. So F stands for fee. That also one needs to look at. Whether you want to go direct or regular, whichever way is, look at the fee in comparison to the overall return. Third, R. R stands for risk-adjusted return. Now, what do we mean by risk-adjusted return? Any return comes out of the fact that your fund manager is taking a set of bets or risks on that portfolio. Now, the funds which one needs to invest are funds which give you the best risk-adjusted return. So for every unit of risk, how much more is my fund manager able to generate return? How does one generate a higher return when markets are going up, and how does one preserve capital when the markets are going down. Both these are examinations that one need to do before you pick up your fund, for which we have something called a market capture ratio. Now, the market capture ratio will give you a sense of how a particular fund has done on up market and how it is done on the down market, and the difference between that will give you a number. Now, there are various ways of looking at risk-adjusted return. There's a Sharpe ratio, there is a downward probability ratio, so on and so forth. But this is a simple way we thought you can look at from that perspective of understanding how a particular scheme is performed from a risk-adjusted return perspective. Like I mentioned, there is a detailed table that we will examine now on risk-adjusted return. I stands for index. Now, every fund that you invest in, except being index funds or ETFs, are designed to try and beat the index. The fund manager's role in that is to see whether he can outperform the particular index. This is available, this is a very simple metric, and it's available in the fact sheet itself. So it's great to look at this metric and see if the fund that you're investing in is performing superior to the index at various points in times. It's quite likely at various points in time that sometimes the index is better performing than your fund manager. But as long as in the medium and long term, you are getting an alpha, which is at least a percentage or two more than the index, I think it's well worth looking at this fund. So performance over index is what we look at as I. So that's another measure. There's a table available. Please examine that table from that perspective. Last, as I mentioned, is S. S, which was the first letter of our SPFRI. Now, S stands for schemes which are overlapping with one another. Now, what do I mean by that? Let us say you wanted to invest in large cap funds and you wanted to invest in two large cap funds. Now, it's important to understand that while a mutual fund invests your money into multiple equity stock portfolios, you don't want both the schemes to have the identical portfolios. You want both the portfolios to have a very different portfolio so that you can diversify your investment. So the scheme overlap is an extremely important criteria for you to look at when choosing your schemes as well. There are cases where there are almost 80-90% overlap between two schemes. Now, what that does to your portfolio is that doesn't diversify your portfolio enough. So if something were to happen to the market, both your schemes will underperform or both your schemes will perform brilliantly. Now, that's not what we want, right? We want schemes which have two distinct portfolios. Of course, there will be an overlap to a certain extent, but the overlap should not be too much. That's really the idea. So you need to look at what is scheme overlap. So like I said, once choosing a mutual fund is a reasonably simple exercise if you consider your internal factors of goal, risk appetite, and tenure for which you want to put that money away. If that's sorted, then you come to the external, which is in the external fund space, and you want to pick up funds based on the SPFRI. You look at performance of the fund, the past performance, which is the only data point really you have, right? You don't have anything more. You look at the past performance, you look at the current portfolio statements. Mutual funds have to reveal the entire portfolio, 100% portfolio of their investments. So you have 100% disclosure on portfolio, both of which you can see. You need to look at the fee structure and find out if it's in accordance with your liking and your thoughts. Third, is the risk-adjusted return working in your favor as per data? How does the performance of the fund do against the index? Are they outperforming the index consistently? That's the I. Last, is there a scheme overlap? And there will be overlaps, but is that overlap significant? That's the other thing that one needs to look at. So if you have looked at all these factors, I'm sure you will be able to choose the fund that's appropriate to you. One of the ways to check at historical performance is either to use a point-to-point return or look at rolling returns as a way. In the current chart that you see now, we have used a 3-year rolling return as the way basis of computation. Now, why are rolling returns superior to point-to-point? Because as compared to a point-to-point return, a rolling return has more data points that are averaged. For a 3-year rolling return, you have data points from November 2018 to November 2021, December 2018 to December 2021, every 3 year on a month-on-month basis, in fact, daily for 3-year period, right up to 25th of August, which is the date on which this chart was taken, has been analyzed right through in terms of finding. Now, because this is an entire average of this period, this is likely to be far more superior than just taking a point to another point. So, which is why we choose the rolling return as a much more refined version of checking performances. So what we have done here is we have looked at 5 large cap funds evaluated. Like I mentioned, we are using the advisorkhoj.com tool to examine this. And there are 2 aspects one can look at. One is what is called the return statistics percentage and the return distribution percentage. Both of these will give us key insights into performance of these schemes. I just want to give a disclaimer. We have no interest in promoting one scheme against the other. This is just to understand how the tool works and how this function works. Nothing more, nothing less. So as you can see in this, the return statistic shows what is the average return during the last 3-year rolling returns of each of these schemes. And from this, while it is evident that Nippon is among the highest and Canara Robeco is also 18.1, between Canara Robeco and Nippon, you would find that the maximum minimum range is much more benign for Canara Robeco rather than the Nippon. Nippon has a wide range. The maximum is really high. The returns have tended to be up and down in a much more larger sense as compared to Canara Robeco, which has been up and down, yes, but in a much more narrower sense. So what this gives us a sense is that even between funds which give you the same returns, one can find out which fund has had a journey that has been more predictable in that sense. And by no means Nippon is not a good fund, Nippon is a great fund too, but the data tends to indicate that the band of high and low for Canara has been much more narrower than for Nippon, which is what it is. And the equity large cap category as a whole, how has it performed and how has the outperformance been? Category return is about 14.35 during that 3-year period, whereas most of the funds which we've chosen here have outperformed in that category. So this is one side, the return statistics percentage. The other is the return distribution percentage. The return distribution talks about percentage returns in different categories, different buckets. So how much percentage of time in the last 3 years has the fund delivered 0 to 8%, 8 to 10%, 10 to 12%, 12 to 15%, and 15 to 20%, and greater than 20%. So if you notice, Canara Robeco Blue Chip has reasonably large quantum of its percentage time in 15 to 20% and greater than 20%, which means that it is, as a fund, a large part of the time it has generated superior returns. But I would also look at something like a Mirai or a HDFC, which is an even distribution across all 3, which is 12 to 15%, 15 to 20%, and greater than 20% in some sort of an even fashion, giving you that sense that not only have they given superior returns, but they have consistently paid within a certain basket of returns. So this helps you understand how the past performance is. Like the mutual fund disclosure says, past performance is no guarantee of future, but this gives you a little bit more insight as to how the fund manager has managed the fund and delivered returns. So clearly you will see that A clear example that the equity fund category has more or less largely performed in line with this, but most of the returns has come in the period of 12 to 15% or 15 to 20% and thereabouts, whereas some of the funds have major returns in the 15 to 20 and greater than 20%. So to that extent, those are funds which have kind of outperformed the larger index, so gives you a sense of those funds. So I hope this gives a greater insight. Let data speak the language, take the inputs and make the assessment of what you want to make. The TER chart explains the fee that one can kind of charge. Like I mentioned, effective April 2020, TER limits have been specified by SEBI. TER stands for total expense ratio. The mutual fund can charge a maximum fee of 2.25% on the first 500 crores. These are for equity funds. On the next 250 crores, it is 2%. On the next 1,250 crores, is 1.75. On the next 3,000 crores, it's 1.6. The next 5,000 crores, it's 1.5%. And on the next 40,000 crores, for every 5,000 crores, the expense ratio will keep reducing by 0.05%. So the idea is, as the assets grow larger, the expense ratio has to go down because the fund manager has the volume to play with. In addition to this, mutual funds are allowed to charge up to 30 basis points if the new inflows come from retail investors beyond the top 30 cities. Now, why is TER important? Because TER has a bearing on the scheme NAV. The scheme NAV, which is shown to you, is after deducting this total expense ratio. So to that extent, if your fund or a fund manager is significantly underperforming for a long period of time, short period of time, every fund manager will underperform. But if for long periods of time, if they are underperforming, then they don't deserve the TER. As a result, you need to look at other schemes to which you need to invest money. Next, we look at what is the risk-adjusted return. So this we drew through what is called a market capture ratios. As you can see in the chart, we have again used a tool of advisorkhoj to understand this ratio, which is market capture ratios. We have used a 3-year data point across 5 of the large cap funds which we've used earlier as well. These are mutual funds which are very popular, and this looks at the last 3 years, how the scheme has returned, and it also looks at upmarket capture and down market capture. What do we mean by upmarket capture? How much of the scheme has benefited out of the upmarket? So the best is 100%, and beyond 100% is even better. The worst is very low returns. So which means on the upmarket, if a scheme has 100% and above, it means that they have done exceptionally well. They have done better than the market, better than index in capturing the upside growth. Simultaneously, they need to keep a very low percentage on the downside market. So if a fund has done exceptionally well on the upside, but also done exceptionally high on the downside market, then the capture ratio will be less than 1. So the idea is the best performing funds are those which have a capture ratio which is above 1. 1 and above is considered good. Higher the capture ratio, higher it means. And the capture ratio is nothing but upmarket capture ratio divided by the down market capture ratio. So in this case, as you can see, Nippon India large cap fund has a capture ratio 1.2, and HDFC top 100 has a capture ratio 1.26. These are the two funds that have really kind of done exceptionally well in the last 3 years on the upmarket capture, and on the downside haven't been so badly impacted either. So the combination of these two give you a sense of how these funds have performed in both cycles. And this is the kind of risk-adjusted return that one needs to look at. Like I said, risk-adjusted return can be looked at in multiple ways. You can look at it as a Sharpe ratio in multiple ways. But this is a simple tool that's available. So we thought we will use this tool to explain to investors that this can be one way to look at how one can look at the better performing fund to pick up. And the last report is the portfolio overlap report. Like we said, the idea of investing in two different funds, even within the same category, let's say large cap or mid cap or small cap, if you're investing in two funds, the idea essentially is to see that I am not investing in exactly the same stocks 100%. There will always be overlap. There is no way you can avoid overlap, but question of how much is the percentage of overlap. Now we have taken two examples just for comparison's sakes. Here we are examined as on current date the HDFC Top 100 Fund versus the Nippon India Large Cap Fund. These datas are a month old. It's not exactly to the date because portfolio disclosure happens only once a month. So these are dated to a month. There you will see that HDFC mutual fund has a 73% commonality with the Nippon India Large Cap Fund and 22% uncommon. So to that extent, if you have both HDFC Top 100 and Nippon, there are common funds. And if you take Nippon funds with HDFC, then there is a 69% commonality that is there with HDFC. So almost a 70% commonality in funds, but the percentage holdings may still be different. So to that extent, returns may still be a factor of differing returns based on this. But having said that, I think this is an important criteria for somebody to look at as well. So choose funds which have lower portfolio cross-holding or overlaps. That way you will get a much more diversified holding. But before I exit, one quick question. If you're new to mutual funds, do not try and do a random fund. Go to a diversified portfolio fund. Start with a large cap fund or a hybrid fund as your first choice. Get some experience in, do something, and then go for other experiments. Sometimes we look at the glamour of small cap funds or some of the thematic funds which are giving great returns in the short term and put a lot of money there and then lose out. So don't do that. Be consistent. Better to start slow and small through SIP route rather than try to make big money overnight.